We're going to talk a little bit about expanding the tradable universe today. And my name is Dave Silver. I lead the institutional options business at Citadel Securities. And I'm thrilled to be joined on stage by three people with three unique lenses into the tradable universe. We have Chris Larkin, who looks after trading and investing at E-Trade, which is a division of Morgan Stanley. Tom Gallagher, the CEO and founder of Miami International Holdings, or the MIAX, and Dean Kernut, the founder of Macro Risk Advisors. I think what we'll do is have each of you do a brief introduction and maybe what's top of mind about the universe nowadays. Chris, maybe you'll take us out.
Yeah, no problem at all. Good to see everybody here. Again, Chris Larkin, head of trading and investing for E-Trade. My team is responsible for building out the digital client experience for our 3.5 million customers on the self-directed brokerage side. We're also responsible for the product distribution through those platforms, so equities, options, futures, fixed income, mutual funds, ETFs, and soon to be crypto, now that the banking sector is allowed to enter the space. I would say top of mind, I would say two things. One is it's already been hard to be a New York Giants fan after this weekend. Every year I'm very optimistic that didn't really work out so far. And secondly, I guess from a thought process, top of mind is I'm thinking about sort of artificial intelligence. Today is the OpenAI Dev Conference that's going on right now, so there's a lot of news that's being released right now. And it's a topic that I think is not only important today, but I think it's going to kind of shape the way things are going to happen in the future as well.
That's great. Tom?
Good afternoon. Thank you for attending the panel. My name is Tom Gallagher. I'm the chairman and CEO of Miami International Holdings, a recent IPO graduate from August of 2 months ago. And we own and operate 9 exchanges. Our first exchange was launched on December 7th, 2012, who launches a business on Pearl Harbor Day, but we survived that. And today we're the 14th largest derivatives exchange operator in the world. So I'm really pleased to tell a little bit of my story and my insights. Thank you.
Great. And Dean?
Well, Dave, thanks to you for hosting this panel, and thanks to Citadel for hosting this event. I'm Dean Kernut, and I run a broker-dealer, Macro Risk Advisors, that's very focused on option trading and helping people think about managing risk through options. I spent a lot of time just thinking about insurance and the markets that help investors manage and hedge against uncertainty. On the way in here, I was reading about the government shutdown and how the prediction markets are making their way into street analyst reports on how long the shutdown will last. And I took one look at Kalshi. Not only does it have odds, it's got odds by the number of days. So you have an entire curve of uncertainty priced into these prediction markets. And I think it's just a fascinating time where fintech and derivatives are really colliding. The technology is getting increasingly sharp, and innovation is really strong right now. So I'm excited to participate. Thank you, Dave.
Great. You could be a Jet fan, so that would be worse.
That'd be worse.
True. That'd be worse.
You made me feel better already.
Yeah, I'm trying. So Chris, maybe we'll start with you. And the spirit of AI, maybe I'll give you a little bit of a prompt around what we're talking about. And I want to be careful not to focus too much on options because the universe is so much bigger. But when you think about kind of moments in time when markets change and you think of what the cause of those changes are, the OCC, the Options Clearing Corp, the average daily volume in 2000 was less than 3 million contracts a day. And that was right around the time of multi-listing and decimalization, and you really saw a large increase over the next 10 years as that took off, all the way to 2010. You were seeing like a 15 million contract a day number from less than 3. And in 2019, when the next big event occurred, you were still hovering in that 18, 19 million contracts a day. And then you had COVID. You had a change in the demographic of your average investor, perhaps. You had the growth of apps and online trading. You had commission-free trading. And in 2024, for example, you saw those numbers closer to 47, 50 million contracts a day. And most recently, September of 2025, we're over 66 million contracts a day. When you think of that, and you think about what else is changing now, if you read the headlines, retail is a constant word that is used or pointed out as a driver of this growth. So when you think of the universe, you have, Dean mentions Kalshi, you think of crypto, you think of tokenization, all these different trading environments that are starting to exist now. The common thread in the headlines is retail. So in your seat, how do you interpret that and think about it?
Well, I mean, first, it's good to be invited to the party because about, I would say 5, 6 years ago, not many people cared about the retail universe and they didn't think it had much of an impact. We would always be sort of the last panel of the day when we do some kind of discussion from an industry perspective. But a lot's happened over time. We've seen, like you've mentioned, there's been sort of this steady growth that's been happening in the industry. But the real change, I mean, you have to just go back to the end of 2019 when all of our competition went to free trading. That was a major change, for all of us. And so we saw immediate behavior changes happening on the retail side. Clients started to break up their trades and become a lot more active on their side. So if they bought 1,000 shares, they decided to do those 1,000 in 3 separate trades because they didn't have that friction anymore. It wouldn't cost them that sort of commission each time. And then that just jumped into sort of the idea around COVID. COVID came in and there was a massive influx of young investors that were coming into the marketplace. A massive, like literally, we've never seen something like this before. And just to give you a perspective, at the end of 2019, E-Trade was doing about 280,000 trades a day. Fast forward into sort of the times of COVID, we were hitting 2.6 million trades per day. So 10x growth happening almost overnight and put a lot of strain on the system from our side. And then you've had all these other things that are happening that impact the retail investors. So you got the COVID, a lot of money coming into the system, a little bit of free money coming in there. You have interest rates going down, inflation starts going up, interest rates go higher. All that cash starts to move off the sideline. Just to give you sort of an example, for fixed income, just treasury trades alone, we used to do about 1,000 trades a month back in early 2020. We went to 60,000 trades a month on the treasury side. So massive growth happening on the fixed income side. And then you look at today. Today you've got sort of so many things that are happening in the world with all the volatility and whatnot. And you've seen so much going on, and that kind of ties into the idea around the options market. The great thing about the options market really is the versatility of the particular product, and our retail clients have spent a lot of time educating themselves to be able to take advantage of all those different ways that can help them with their portfolios. So it's been a great time to grow from the retail side, but I think specifically on the options side, we've seen just tremendous growth happening.
Yep. I mean, Tom, you have a unique challenge and also opportunity to kind of be innovative and stay ahead of some of these asks of retail and other investors as an exchange operator. How are you thinking about just today and the future of it?
Well, I think that the exchanges play a major role as firms like Citadel and other firms go out and they provide best X services to people like Schwab and Robert and others. I find myself as the plumber of capitalism. We have to really help the market-making community in creating more liquidity. And so we've invested a ton of money in our systems in terms of throughput, latency, and determinism. I like to say that 10 years ago, I built the church for Easter Sunday. I had that feeling that there was gonna come a point in time where you needed to have 32 million messages a second get processed. And so for my first 10 years, until that Friday afternoon, March 13th, when President Trump declared the COVID a national pandemic, prior to that time, if there was volatility, the incumbents would go to what they thought was a safer venue. From that day forward, on Monday, March 16th, till today, we've grown over 1,100 basis points of market share because the experience and the investment that I made in infrastructure has served us dramatically well. So that consistent, predictable latency so that market makers can refresh their prices extremely quickly. So I think the exchanges play an important role in allowing this retail growth by making sure there's a safe venue for these things to happen.
Yeah, it's great. It's been great to see the resilience of the marketplace to allow this to kind of happen and to have the confidence in the financial services industry and the marketplace. So, Dean, it's funny, I think of our career paths working closely together over time and thinking about the institutional investor, kind of Chris's point, it was always kind of institutions, and then there was retail. I'm curious, how have institutional investors, not just in the current product set, but in the more kind of event-driven or kind of product of like the next generation of products, how are institutions thinking about it to make sure they're ahead of that to continue to be a place that people want to invest? And then how do they invest themselves?
Yeah, so Dave, when you and I met each other, 20 years ago, the equity derivatives market was becoming more institutional. The bid offers were narrowing. There was a move towards pennies. Technology was getting better. And so you saw the advent of hedge funds that were really, really active in the options market. And maybe it's been kind of growing, but the real kind of moment for retail, I think, as Chris referenced, was the pandemic. I think I've read that FINRA estimates that 38% of new accounts opened in 2020 were by someone that never had a brokerage account before. So this, democratization and plus being at home and technology has really become a thing. And I was saying to my panelists, the GME moment in January of 2021 was in some ways a turning point for the manner in which the presence of retail was rethought. When folks started trying to get their arms around GME as a risk factor, meaning on the short side, they found this thing called Wall Street bets. And what they found on Wall Street bets was not the kind of conspiracy theory language that they expected. They came across terms like gamma and vega, that this retail community is actually much more well-educated around financial products, smarter than I think people suspected, and very importantly, and this is where it comes down to managing flows, is that there are times when there is a sameness of view amongst all of these folks. I say if you told 1 million people to buy one option contract at one time, that's a lot of demand for an option in a very short period of time, right? So you have this legion of traders that can sometimes act in a similar way, not always, but sometimes. And what it's meant for the institutional community charged with making prices for all of these different options across time and strike is a newfound respect for, I think, tail risk, not just to the downside. Obviously, stocks can collapse, but also the upside, which is what we saw in GME and some of the other meme stocks.
Yep. We're seeing it again even in today's market with new topics that are taking stocks higher and vols higher as well, so it's interesting. Maybe we'll switch gears a little bit. Tom, you made mention of being the CEO of a recently public company, and congratulations on your IPO and the success of that. I think we're living in a world, up until perhaps even just a few weeks or months ago, there were more private companies than ever. Companies are certainly staying private longer, not just because they're in vogue, but for lots of reasons. I'd be curious about your journey of going public and becoming a public company, and then maybe Chris and Dean could share kind of how their investor base are thinking about how to benefit from public companies and demand for those companies as well.
Sure, well, thank you for the question. So having started this at age 50, 17 years ago, my ex, driving home from the New York Stock Exchange on August 14th, I kind of felt like Rory McIlroy in that I had 500 investors asking me every day, when are you guys gonna go public? So it was a relief, but what fueled our growth was the continued revenue from the mature options business that we had started about 12 years ago, and also the innovation that we have brought to the marketplace. I had been trying to become public for 3 years, but it just seemed like every time we were ready, the markets weren't there. So I saw a window right after Liberation Day, maybe May 1st, that if we could possibly become a public company. So we pitched our deal to 400 firms over the course of about 2 months. And fortunately, we were 18 times oversubscribed when we launched on the exchange. And we've been very satisfied with the reception by the marketplace. But the real important thing for me is when you compete globally for technology talent, it's hard to compete if your competition is publicly traded. So this gave us an opportunity to have employees get stock options, to retain and hire new folks, and we also paid some debt back. This year, the IPO market, and Chris is more the expert than me, it's raised about $32 billion. Last year, it was about $31 billion that was raised. And unlike last year, the largest sector in the IPO market this year for the first 9 months was financial services and fintech, whereas it was healthcare last year. So the market is open. We hit that window, and I'm grateful to the buy-side community that have supported us.
That's great. Chris, it's interesting. You think about IPOs, and you think of retail, and you think about the changing demographic of the investors. With all the tradable products that exist now, does the retail investor still have demand for IPOs the way that they used to? Is that something that you still see through your role?
Yeah, I mean, there's always demand. I think that it's a natural thing when something is so hard to get access to. There's generally sort of more demand that gets brought together, and I think that the challenge has always been, I think, for the retail investors is getting access. I'm lucky to be combining with Morgan Stanley, so our clients get the opportunity to participate in IPOs. We are obviously a leading investment bank, and so our clients get a chance to do that. So that's a big thing. There's always an allure for someone to get in as the first person from an IPO perspective. And then also, I think from Morgan Stanley as well, we're one of the largest stock plan administrators in the market today. I think we serve over 50% of the S&P 500, and we've served both public and private companies along the way. And I agree totally with Tom. It's like when you're competing for talent, being able to award them employees with options or RSUs and those types of products are very important from a recruiting standpoint, very important from a retention standpoint. And so that's a big business of ours. And if you think about sort of the growth of it, the private part of the market also has been very large as well. So if you look at the companies today, if you look back in the 80s, it took a company about 6 years to go public. That number is more than doubled today. So there's more and more companies that are staying private. We need to serve them, but we're also a big advocate of being able to give our clients access to private markets as well. So we're looking to lower the bar in terms of the ability for people to access companies like SpaceX and things like that. We try to advocate in a big way. So it's a big part of the market, and I think the other thing is from a sentiment perspective and for clients' interest in the markets, our clients it's a much more interesting market, and our clients are much more active when there's single stock stories that are happening. A lot of times when markets are under distress, people will start to gravitate towards the ETFs, more of the passive types of products. They still trade them often, but they go to more of those broad-based things. And I think that when there's interesting stories that are happening in the market, you see a lot more activity, and that's all driven today. I think I mentioned earlier about artificial intelligence. That has been a big theme for the past 2 years. It has sort of exposed a lot of really interesting companies that our clients are very interested in trading.
Yeah, that's very cool. Dean, I'll kind of add a little bit to the question just around private versus public. Right, private markets, especially over the last 10 years, you've seen institutions kind of lead the experience of investing in private companies. Many of the largest asset managers were very early to that. If you want to kind of shed some light on that, I'd be curious. What about the kind of choice of investing and the future of investing in terms of private versus public, especially as more IPOs are happening? How do you think about that? And how are investors thinking about that?
Yeah, obviously there's a huge growth in private credit, private equity, at least purportedly in response to the goal of trying to find excess return, right? You're getting paid some risk premium for bearing the risk that's otherwise inaccessible through public markets, and I think there's something to that. I also happen to think very strongly that the manner in which public markets provide radical price transparency, right? The flickering in real time to really understand where an asset can be disposed of or where it can be acquired. I think there's just a lot of value in bringing these assets into the light and having the capacity to mark them to market instantaneously. But of course, it's just all about the price. If you're getting compensated properly for bearing complexity risk, illiquidity risk, there's all kinds of dimensions of risk you might be either well compensated for or not. I did want to make just one comment about stepping back and looking at the IPO market this year and just observing what's on the docket. And I think this panel really is about the collision of financial markets and technology with a heavy dose of financial innovation as well. Circle has been a really interesting company to follow. Of course, I'm in the options market, so it's something that comes naturally for me to look at. But the option volume for Circle in at least the first couple of months, it's come down a little bit. For first couple of months, it was 7 times the combined option volume per day than Visa and MasterCard. And so it just tells you how excited people are around these companies and the promise. It doesn't mean it'll always work out, of course, but the kind of optionality that's embedded in these new IPOs is extraordinary. The stocks themselves are options, and I think the democratization, giving individual investors access to this, I think is a benefit for society at large.
Yeah. So maybe we stay with you, Dean, for a minute. A senior bank officer recently at a conference used the word derivativization, which I rehearsed many times before I chose to use it today. But the derivativization of the markets, right? The tokenization, event trading, obviously crypto, blockchain, all these terms have kind of come to top of mind when people talk about investing now. And to your points about technology and just kind of interest in investing, and to lack of better word, betting or trading, when you hear this and you think of it being such a driver of both revenue, opportunity, volumes, where are investors' heads right now, and what are they hoping for? I mean, even topics such as 24/5, we've had some exchanges ask for 0 DTE for single stocks. There are so many things that might become tradable that there's demand for. Kind of where should people be kind of putting their brain power, or firms like Tom's, where should they be leaning into?
It's to me a super interesting time with the development of these event platforms. I think at the heart of most exercises in analyzing an opportunity are some version of odds, right? Everyone is interested in the odds relative to the payout. That's how we judge risk and reward. Sometimes the odds are not as simple as yes or no. Sometimes, and we see this very often with tail risk scenarios in markets, the odds on you making money are very high, but then the odds of a truly catastrophic loss are there too, right? That's kind of selling volatility. And and I'll sort of start with the event platforms. What the event platforms are doing is giving us a distribution of potential outcomes that we had no glimpse of before. Now, some of them are, culture bets, and as I mentioned, the bet on the shutdown. I'll give an example from last year. When Biden was holding the line and thinking about dropping out, you just had to look at a platform like Kalshi to understand if a new piece of news had hit. The news was not that he was thinking about dropping out or that there was a meeting. The news was the change in probability. That's what you knew. That's what you looked at first. And then you just had to backtrack and find out what the news was. So the news becomes the odds. And I feel like we're on the horizon with a lot of experimentation that won't work. That's definitely a part of financial innovation. A lot of these things will be tried and they won't work. But the collision of event contracts with markets is very powerful. Yes or no is something that everyone can get their arms around. And so with regard to how they're contracted, it's one or the other, and you know the expiration. So you can get your arms around the odds, and you can also collateralize them very easy as well, right? You know exactly what you can lose. So I find that to be a pretty interesting trend right now in markets. It's a unique time with technology, and I think it's got legs. I think it's
Dave,
powerful.
can I comment on that?
Please.
So when you're talking now about event-based contracts, those are the purview of the CFTC. There's 2 industries for the last 75 years that have never been regulated at the federal level. One is insurance. Every state has an insurance commissioner. There's no national insurance commission. And gaming. Gaming was the purview of the 50 states. Now today, you're seeing a convergence where the CFTC is being asked to approve a prediction contract on the outcome of an election. And they're also being asked to look at contract specs with respect to events based upon the outcome of a sporting event. So when you talk about earlier, Dave, a collision of technology, finance, I think I'd add regulation to that. We're seeing some things that I think we haven't seen in many, many years. You go back to 1988, Indian gaming was legalized by the Supreme Court. Then you go back to 2018, you see that online gaming was allowed. Now, last summer, there was cases that basically held that an event-based contract on the outcome of a sporting event is no different than betting on how high the corn's gonna be in Nebraska. So I don't know where this is going to turn out, but I really think we are at a point that we are gonna see a proliferation of these products in the retail space, and I think we need to be prepared both on the infrastructure side, the risk side, because it's coming right at us.
Yeah, for sure. Chris, I would imagine your clients, I mean, especially to some of your comments earlier about the changing demographics of maybe the younger investor, how does this platform like yours, I mean, do you see this demand for all these products? Can you access them through your platform? Do you have a view on kind of the ability, in more of the event space? And then maybe we'll shift gears a little bit and talk about the longer trading day or the shorter dated expirations.
Yeah, I think I would say that, behaviors continue to change over time, and a lot of that has to do with technology and some other innovative ideas that go on. Like a good example I always like to say is, I worked for a company called Datetech Online quite some time ago, and we were the first person in the industry to offer a 60-second execution guarantee on a market order. And nobody in the industry could match it. They literally could not match a minute to get a market order. Today, we execute those in 0.1 seconds, an average order. So at the blink of an eye, you can execute an order, and that's just an industry perspective, not just E-Trade. And so as technology gets better, I think also the mindsets of the retail investors have changed as well. They're a lot more, I would say that they're a little bit more shorter term focused, a bit more speculative in the marketplace. But when you're thinking about sort of the younger investors where you see a lot of this interest from some of these products that we're talking about today, and I think both of these gentlemen said the same thing, it's like simplicity does rule, like people do gravitate towards simplicity. And these products are very simple to understand and simple to trade. You look at something like options, which is a great product, but like it takes time to learn that product. It's got some esoteric sort of language to it, and some things that people need to learn before they start trading it. When you start getting involved in a product like prediction markets, it's very simple. Like you said, it's a yes or no answer. You've got an opinion, you just decide that you want to make that particular investment in it. So that's that, and I think other things, like you look at the idea like this, especially within those particular markets, like I'll talk a little about the futures market, kind of the same mindset. As retailers continue to grow in those particular products, what they've done over time is to basically reduce the size of the contract. So there's the most popular contracts on our platform for futures are these micro contracts that you trade on sort of the equity products. You can do it on Bitcoin. And our clients gravitates towards smaller defined risk in the products that they're trading, and that continues to grow. So this idea and this concept around a little bit of speculation will always be involved in the marketplace in some capacity, and in smaller sizes and in simplicity. Those are like really good combination of things that I would say that are really good products from a retail perspective. And firms like Kalshi, who's going to be here, I believe, afterwards. Yeah. If you don't know much about them, you're going to love that panel because they've done an amazing job. I've actually been speaking to them for about 3 years. I've not been able to offer my platform yet. But I do think, based upon sort of the demand that we're hearing and what we're seeing in the marketplace, prediction markets, they're here to stay. And I'm very bullish on sort of the idea around the particular concept.
Yeah, it's definitely a lot of different dimensions all coming together at once. I mean, Dean, I love the way you said kind of a yes or no type outcome. When you think of yes or no, you kind of think of it more as like a trade or, for lack of a better word, a bet, right? Very different than the investable universe, right? Like we talked about expanding the tradable universe as opposed to the investable universe. As an audience full of a combination of traders and investors, how as an investor do you need to almost change your entire process going forward? You're a traditional asset manager, a fiduciary to pick good stocks, right? Has that changed as a, for lack of a broader expression, like as a as an industry, has that really changed as trading has taken over investing?
Yeah, I think the attention span of the world is definitely shortened, right? The tweets, 0 days to expiration options, event contracts that are very short term. So it's certainly the case that the world is moving faster, at least it feels that way. I think, Dave, to your question, the risk, I think, of over trading is potentially there. You know, that more choice I believe very much in. I think access to products is valuable. I think it sometimes can be a distraction. I think, you know, you want to find yourself generally in the position of trying to be a buy and hold investor. But at the same time, you know, let's take 0 days to expiration options. I was talking to a guest here today earlier at lunch around the proliferation of it with the assumption that this was just a retail trader's, you know, just kind of gambling back and forth product. And I'm sure there's some element of that, but boy, this is a very largely adopted institutional product where the largest global macro hedge funds, believe it or not, are using 0 days to expiration options. And they're not saying, well, it's 9:30 in the morning and I have a hunch that by 4 the S&P is going to be higher than it is now. They're using these as overlays against a very large book of all kinds of, you know, different types of exposures, whether it be credit risk, various tail risks, different volatility exposures. So they find their way into the portfolio for reasons that aren't really, you know, that you would say are kind of gambling. They actually have a real institutional view. So to answer your question, I think there's still very much the operative focus should be buy and hold, but with a broader swath of products to potentially manage very concentrated event risks. You know, I'm sure everyone in this room is seeing the way in which the VIX, one day VIX will go up ahead of the CPI, right? That was very much a thing in 2022. Folks are really trying to hedge just that print, just the CPI day. And you can do that through one-day options. You could do it even more granularly with something like an event contract on the CPI outcome. So to me, more choice is a valuable thing.
You know, Tom, as an exchange operator, one of the things that you will probably have to deal with are longer trading days, shorter expirations, or I should just say more expirations, and possibly even new products. Some of that's obviously, you know, one exchange is filed for shorter dated 0 DTE in single stocks. 24/5 is definitely here to stay in various markets, and there's obviously global trading hours for some products. As an exchange operator, how are you thinking about making sure that you're able to be open for that business?
So with the longer trading days and the 24/6, I'm still trying to figure out if going 24 hours a day is going to bring more new volume into the marketplace, or are we spreading the same amount of volume over 24 hours?
Right.
And do we really, all of us, need the infrastructure enhancements to deal with 24-hour trading if it's really just pushing around the same volume? So I'm a bit skeptical right now in terms of the need. I know it's coming, but
Yep.
I'm not so sure there's new volume coming or just the same volume spread out over 24 hours. On the 0 dated options, obviously it's good for the marketplace. It's more products. It's more opportunities for trading. It also presents more infrastructure requirements because of, I don't know where the average daily volume is going to go, but I think it's safe to say it's going up. And like anything else, I think you just have to be careful that there's not an excess. Definitely, I think there's going to be even more volume coming as a result of these short-dated products. But I also think that exchanges have to make sure they're ready too.
Dave, can I just quickly jump in on that? I think more price discovery in general, better. But to Tom's point, if we're just spreading it out, I think that's maybe not as additive. And then the other thing I just would say is, if you've got to mark your book to market every day, that's one thing. If it's 24 hours a day, meaning I might have to mark my book to a 10 p.m. set on the VIX, which just went haywire because someone had to get out of a bunch of VIX futures, right? So it becomes almost the mark-to-market component of it. If we're truly to take these off normal hours prices seriously, that is a consideration as well.
Yeah, for sure. Chris, any demand that you're seeing for all of these products when these guys talk a bit about maybe we're just spreading the volume as opposed to increasing the volume? Have you found, I mean, we talked about volume curves back in the day. It feels like that narrative has lowered itself, but do you anticipate more product create more trading?
Yeah, I think that like if you think that we're talking a little about the idea of the growth of the options market, and I think we're talking about these zero-dated expirations, and I'm not sure everybody's knowledge around the options side. These are short-dated options, and just to kind of level set, they're issued 2 weeks before, but the difference is there's an expiration on every single day. They're only on index products today, but you have an expiration every single day on these indexes. So they're not created today and they expire tomorrow. For some reason they call them 0 days expiration. It sounds like it does, but that's actually not the case. And so there's been really good demand. And if you take in totality, on single stocks only expire on Fridays. So you take all the volume that happens on a Friday in a single stock, and then you take all the volume that happens on the index side. It's about, from a retail perspective, you're talking about 25% of the volume that happens in a given month happens on these expiration Fridays because there's a lot of trading that's happening. Some speculation, but people are sort of managing their positions. They're rolling a call or a put over for another month. So there's a bunch of activity happening that day. Kind of requires you to take action. And that's why you see sort of all that volume that's coming in from there. And then they're talking about the idea of offering everyday expirations on single stocks as well. Yes, it will drive more volume to the marketplace. There are more risks in doing so. It's part of, like, if you think about the idea, we're talking about technology. One of the things that happens obviously every day is that you've got news stories breaking. There's earnings that are happening throughout during the week, and they have these expiration on Fridays. At the end of the trading day, because there is basically no news ever that's being released on that day. So you don't have to worry about the volatility of a product and what the outcomes that can happen. So there's some things that are risky, and that's why we're making some comments. Do we really want to sort of introduce single stocks? 24/5 is, I think there's a few things. One is that, there's not massive demand to start trading between midnight and 4:30 a.m. in the U.S. for retail clients. It's just not the case. You're going to get some volume, that's fine. But there's not a big demand. I think it's a little bit of a marketing thing to get that idea that you're going to operate around the clock. I do think that there is some benefit by extending the hours. Typically, we go to 8 p.m. Extending that to around midnight does make a little bit of sense. It's episodic, though. Like, if you think about extended hours since the day that we've done it, I bring back Datetech Online. We're the first people to offer extended hour tradings to retail investors back in the day because it was not available to them. And to be able to take care of the West Coast, where you've obviously got a contingent of folks that are coming home from work and can be able to trade a particular stock, that's fine. But I don't think that we're imminently going to see a ton of volume that's happening overnight for us. The international markets will probably drive some of that. It's already driving it today. South Korea has been sort of a big participant, I would say, within the volume that's happening in the 24-hour market. But I don't think to me, it's not a game changer for our clients, and I don't think it's going to be a game changer for sort of an accelerant of volumes that are happening in the marketplace. But the world is turning 24/5 to soon to be 24/7. And so as a firm such as Morgan Stanley, and I'm sure Tom and any other firm as well, we're all spending a lot of time to make sure that we understand what does it take to operate in a 24-hour environment, because it will come. A lot of it has to do with the cryptocurrency markets that run 24/7. The futures market operate in a 24-hour environment as well. So you've got a little bit of fragmentation that's going on. But the fact is that the world will eventually go there. And so how do we sort of prepare ourselves in a way that we can serve our clients the way that we do today? Not just today, but into the future. And that's not just, I would say, it's not just trading securities. It's moving money, all the different things that we do from a financial services perspective. We got to think of ways of how can we more efficiently serve our customers in an around-the-clock environment. So it's an ongoing sort of preparation that I think it's happening in the industry.
You think about blockchain. Some things we are going to run out of time to talk about, but things like blockchain and things like crypto, those types of innovations and product development have set a tone for more dynamic processing and more dynamic trading. And as people become more engaged with them and used to them, they might look to have that same experience when trading stocks and options and other securities. So we'll see.
Yeah, I think as a comment, just the idea is that you're not, the idea of the blockchain and other things that we've talked about today, and even with AI, the beginning of all this is really working on the efficiency part of the market. It's how do we become more efficient? And there are parts of everything that we do on an everyday basis that is inefficient. I don't think that the markets are inefficient. I think the markets are very efficient. So I think when you start thinking about sort of how does blockchain sort of impact the options and equity business, I think there's a little bit of work to be done. They're talking about tokenizing securities and whatnot. I think that's a longer term conversation that I think the industry has to have in how that actually works. But there is a lot of inefficiency that happens, whether it's me trying to send money from the US to a different country, it's costly. You're seeing a lot of that sort of initial part of the market focusing on efficiency and how can we all be better at what we do and serve all of our clients in a different way.
Dave, a lot of this comes with some major challenges. We've developed time measuring tools. You talk about the 24/6, 24/7, but the volume of trading and this 60 to 70 million contracts a day, we are now at a point where I need to be able to tell a customer if he was 8 billionths of a second behind the prior customer. So we're now measuring time in the billionths of a second, and you need to be able, if you're going to survive in this market as an exchange operator, to be creating systems that if someone invests themselves in technology to get to your matching engine, they want to know that they can get there in a time sequence. Yep. So we're now at the spot where I am able to measure time in 8 billionths of a second intervals. Yep. So it comes, this retail demand that you talk about, Chris, also creates a tremendous infrastructure demand, and that's one of the reasons I think we focused on this technology to be in a position to serve the markets.
Yeah, I even think of my 6 years at Citadel Securities when we would start and be out on marking. We talk about sending 10 billion quotes a second. I think then it was 20 billion, the next sentence was 20 billion quotes. I think we're sending over 40 billion quotes a second at this point. It's really, the numbers really do get quite extraordinary, and the build and the innovation, technology, and requirements to do that are second to none. So, well, look, we have literally 1 minute to do a quick lightning round, which is always my favorite. 66 million equity options was the average daily volume in September of 25. What is it in September of 2016?
So I think that volume and volatility are correlated, and I think there will be a little bit more volatility next year. So I'll say 78 million.
I'm not going to give a prediction, given
Fair enough.
how many lawyers talked to me this morning before I got up here, but
Fair
I
enough.
think it's going to be more than it is today.
Fair enough.
Yeah, no, I think we're going to maintain our double-digit growth is what we've been seeing. There's no reason to think that that's not going to be the case based upon sort of the macro environment that we're experiencing and all the things that are happening in the marketplace today. I would say that the growth is going to continue in the product for sure.
Perfect. Well, guys, I thank all three of you and wish you the best of luck. Thanks again.